In our last episode, we talked about options as a way to generate income. Many people consider options to be a risky way to invest. While it is possible, as with any investment, to lose a lot of money with options, there are option trading strategies that can help you generate significant cash flow with your assets. And that is what we're going to talk about today. Welcome to the First Principles channels. Let's talk options. Let's get it. In today's episode, we're going to look at options contracts, what they are, the types of options contracts out there, and we will also review examples to show the value of options. And if you wait till the end of this video, you will see an example of how you can use penny stocks and options to generate even more value as part of your portfolio. Of course, like we said, we talked about the difference between capital growth and generating cash flow in our last video. If you look in the comment section, there's a link to that video. I'd recommend that you make time to watch that video first before you come to watch this one, because it provides some useful background that will help you to get the most value out of today's episode. So if you haven't done so, please click there, watch the video, and then come back to this one. Okay, let's go into this episode. So what are options? An option contract is a type of contract that allows a party to the contract the right or the obligation to buy or sell 100 units of a particular stock on or before an expiry date of the contract. So there's a few elements here. There's two parties to the contract. There is an expiry date. There is a price that is called the strike price for the option contract. And there is a premium. The premium is paid by the buyer and it is paid to the seller. And there are two main types of options contracts that exist. One is called the call contract. The second one is called the put contract. You can also have multiple combinations of either the call or put contract as part of a trade strategy. So what is a call option? A call option allows the holder of 100 shares of a particular stock to collect a premium in exchange for agreeing to sell the stocks, all 100 of them, at a defined price on or before a specific date in the future. So again, option contracts are usually captured as batches or multiples of 100 units of shares of a particular stock. So if somebody owns 100 units of a particular stock, they can sell a call option, which means that they will receive an amount as a premium, but in exchange for receiving that premium, they are agreeing to sell those shares at a set price within a defined period before the expiration of that defined period. Now, these might all sound Greek to you, and it's funny because options use a lot of Greek terms in their terminologies, but we will look at an example now to help us break this down in ways that we can understand. So let's look at the example of Microsoft. Assuming the date is the 18th of April 2022, Microsoft shares are trading for 278.85, and you've just bought 100 units of Microsoft shares, and you think that a fair price to sell Microsoft is $315. So you are happy to sell your 100 units of Microsoft shares, which you bought at 278.85 for $315. Let's see what will happen if you sold a call contract on such a portfolio. So you then can go into the option chain for Microsoft and you pick a date. So let's assume you want to pick a date of the 13th of May 2022. And like we said, you've bought Microsoft shares, you've owned 100 of them. You're agreeing to sell Microsoft shares at $315. If you sold the Microsoft call option contract that will expire on the 13th of May 2022 for $315 strike price, you will receive 71 cents per share, which means that if you multiply that by 100, you would receive $71 for your call contract. Now, what could happen here? On the 13th of May 2022, if the price of Microsoft is $315 or above, the person who bought your call contract has the right to buy Microsoft from you, all 100 units that you own, at $315. So if, for example, let's say on the 13th of May 2022, Microsoft was trading at $320, you will have to sell your Microsoft shares at $315. And the reason why you have to do that is because on the 18th of April, you received 71 cents per share for agreeing to sell Microsoft shares at $315. The flip side to that coin is if on the 13th of May 2022, the price of Microsoft shares is less than $315, it makes absolutely no sense to the buyer of your call option contract to exercise his right, because why would he want to buy Microsoft shares at $315 when he could have bought it at a lower price in the market? And so this is what option contracts do. They allow people to be able to take a chance on either buying or selling 100 units of shares at a set price at a set time in the future. All right, so let's look at the maths here. So like we said, you've bought Microsoft shares at 278.85 on the 18th of April 2022. So you own 100 units, which means you paid 27,885. And then you have now gone and sold the call option that will expire on the 13th of May 2022 for Microsoft at $315. And for selling that call option, you've received 71 cents per share, which means that your total premium is $71. The time or number of days for the contract is 25 days. So the buyer of your call contract has taken a chance and paid $71 for the opportunity to buy Microsoft shares at $315 because they believe that on the 13th of May, the price of Microsoft will be way higher than $315. Now, there are two possible outcomes here. Outcome number one, like we mentioned, is the price of Microsoft is above $315 on or before the 13th of May 2022. If that happens, you will have to sell Microsoft at $315. Now remember, you received your 71 cents share premium, but your cost on the 18th of April when you bought Microsoft was 278. So that means your total profit per share is $36.86, which is an annualized return on capital, or not annualized, no. This is a return on capital of 13.21, which is not a bad return on capital to make for 25 days. Now, if you're making that kind of money, surely you don't mind if Microsoft is above $315 on the 13th of May, because you're already making some profit if you're not greedy. Now, what is possible outcome number two? Possible outcome number two is on the 13th of May 2022, the price of Microsoft shares is below $315. Now, what does that mean? It means that it makes no sense for the buyer of your call option contract to exercise their right to buy Microsoft at $315 because they can get it at a lower price in the open market, which means that on the 13th of May, your option contract will expire worthless, which means you get to pocket your Microsoft shares still, and you also get to keep the 71 cents per contract. Now, your return on capital is 0.25%, and the annualized return, that is, if you kept making that 0.25% every 25 days, is about 3.72%. Again, not a bad way to earn decent income on your assets, given that you would potentially also still be earning dividend on the Microsoft shares that you own. Now, if you're liking what you're hearing so far and it sounds simple enough, as always, please like and show your love for the content by hitting the like button. Share this video with people who you think will find the information useful. And if you haven't done so already, please hit the subscribe button. We're trying to get to 1,000 subscribers. So we would really appreciate your hitting that subscribe button. And if you've hit the subscribe button, you might as well just hit the notification bell so you're the first to see new videos when they show up on the channel. Okay, so we've talked about call options. Let's look at the other side, put option. A put option, similar to the call option, assigns an obligation to the seller of the put option to buy multiples of 100 shares of a particular stock at an agreed price on or before a specific date. The benefit to the put seller for accepting this obligation is a premium is paid to the seller at the time of the contract. All right, let's make sense of this. So again, we're going back to Microsoft. It is the 18th of April 2022. Microsoft is trading at about 278.85. You don't own any shares of Microsoft, and you feel that a good amount that you would want to pay to own Microsoft shares is $260. So compared to the call option, in this case, you don't own Microsoft shares, but you want to buy Microsoft shares and you would want to pay $260. One option could be that you go into the open market and you put what is called a stop order for Microsoft shares, which means that the broker will take $260 times the number of shares you want to buy, and if ever the price of Microsoft hits $260, then it will be sold to you. Now, the thing with such an option is if the price of Microsoft does not hit $260, you could have blocked $260 times the number of shares you want to buy in perpetuity because you're waiting to buy Microsoft at a certain price. The flip side or the opportunity or alternative is you could sell a put contract for Microsoft shares. However, you would need to be willing to buy 100 units of Microsoft shares. And for selling that put contract, you then are agreeing that if the price of Microsoft is below $260 or $260 on the expiry date of the contract, you will pay $260. And for agreeing to such terms, you get to receive a premium on the contract that you have just sold. Okay, let's look at an example. So again, it is the 18th of April 2022. Microsoft is trading at $270 something. You want to buy it at $260. So you go to the puts option chain. We're picking the same expiry date, 13th of May 2022, for agreeing to buy Microsoft at $260 on the 13th of May, you will receive a premium of $3.90 per share of Microsoft. So what could happen? There are two possibilities. On the 13th of May, it may be that the price of Microsoft is above $260 per share. What that then means is you will pocket your $390 that was paid. The funds that was blocked from your account to buy those shares will be released back to you. Option expires worthless and you get to keep the premium. If, however, the price of Microsoft drops below $260 on the 13th of May, you have to buy it for $260. So those are the two scenarios that could play out here. All right, let's do the maths. So again, Microsoft is trading at $278.85 on the 18th of April. You have agreed to sell a put contract for the strike price of $260, and for agreeing to sell that contract, your account will be blocked with $26,000. And for agreeing to block those funds to pay for Microsoft shares in the future, you will receive $3.9 per share, which is about $390 per share. And like we said in the call period description, the time to expiry of this contract is 25 days. That is from the 18th of April to the 13th of May 2022. So what are the two scenarios? Outcome number one is that the price of Microsoft falls below $260 on or before the 13th of May. If that happens, you have to fork out $260 per share, which is already blocked from your account, and you need to buy Microsoft at $260. Now, remember, you were already paid $390 per share, which means that even though you're paying $260 to buy the Microsoft shares, your actual cost of the Microsoft shares is $256.10. That's the $260 you paid less the $390 that you received upfront. So it's like buying Microsoft shares at a discount. Outcome number two is on the 13th of May 2022, Microsoft shares are trading above $260. If that happens, the options contract will be worthless, it will expire, and you still get to keep your $390 premium that was paid to you and the $260 that you set aside for buying the contract or the shares if it had been assigned, which means that within that 25-day period, you're making a return of 1.5%. Again, that's not a bad amount to make for just 25 days of investment. So why should you consider options as a way to invest? As we've seen, selling put options on shares you want to own allow you to buy such shares at a discounted price. We saw that with the example of Microsoft. Selling puts can also be a useful way of generating cash flow on shares that you're bullish on, that is, shares that you expect the price to rise or to stay above the strike price by the end of the expiration of the put contract. Selling call options on shares you own allow you to also generate additional income for agreeing to sell those shares at a price point that you're comfortable selling the stocks anyway. Remember, even if you sold those shares at that strike price, you can still go back to the open market to buy those shares, or maybe even decide you want to sell a put so that you can get the shares at a discounted value at a future date. Selling calls can also be a useful method of generating cash flow on stocks you don't mind owning for the long term, but for which you have also determined that you can exit those stocks at a defined price. I hope it's making sense so far. If it is, please do hit that like button, or if you've got questions, please leave a comment in the comment section below and we'll try and get answers to those questions. Now, what should you be mindful of when trading options? Well, if you get assigned on a put that you sold, that is, you have to buy the shares at the agreed price, you are actually saying that you are happy to buy the stock at a higher price than you would normally have bought it in the open market, because you will get assigned if the price of the shares fall below your strike price. When you sell a call on the shares that you own, you're also agreeing to sell the shares at a price less than the market value if the strike price is below the market value at the time of the expiration of the shares. So you're really taking a risk of a potential loss of additional value that you could get from trading options. Some people don't like that idea, but the truth is, if you've already told yourself you're not going to be greedy, it could be a good way to get into or get out of a particular asset. Another thing to be mindful of is that when you're buying an option, you are the one paying the premium to the seller. One thing that we all should be mindful of, especially with certain broker platforms, is option contracts are not free. So you need to factor the price of the options contract, the fees or commissions that you'll be charged by the broker, when you're calculating the total return on investment on your options trading. Cool. So if you've waited this far, here's the bonus section. And there is a options trading strategy that is called the wheel strategy. The wheel strategy is simply a case of you see a stock you want to buy, you know what price point you want to get in on the stock, you keep selling puts on the stock until you get assigned, and if at a point in the future you get assigned, then you start selling calls on the same stock until you get assigned, and if you get assigned, you go back again and start selling puts. So it's like round and round and round with a particular stock. And this strategy can be really, really useful when you're dealing with penny stocks, as we will see in the example we're about to look at. So the example we're looking at here is with an asset class called CEI, which is in the energy space. Now, if you look at the stock price chart for this asset class, you will see that apart from the sharp drop between October and November 2021, it's been going up and down between the $2 price point and the $0.3 price point. So if you, for example, had invested $1,450 in buying CEI in October, your asset would have been worth $391 by April 2022, and no cash flow would have been produced. This is a 73% drop in value of your capital. Like we say, capital can go up or it can go down. But this is where options can be of value to you in generating cash flow and helping to make that drop in the value of the asset easier to swallow. So now let's see what could have happened if you had gone the options route with ticker symbol CEI. On the right hand side of this screen is an actual set of transactions that were executed between the 13th of October 2021 and the 18th of April 2022. And what you see on the left hand side is a summary of what transpired and the kind of cash flow that was generated. So the capital deployed was $1,450, which is the same as what we mentioned in the previous slide. The period from October till April was 187 days. And just by executing on the wheel strategy, which is selling puts, as you see, there were quite a number of puts that were sold, and then when they were assigned, we sold calls, and then when they were assigned, we sold puts again. By going through that cycle of selling puts, getting assigned, selling calls, getting assigned, selling puts all over again, we were able to generate a cash flow of $1,138 on a $1,450 investment over 187 days. The fees that were charged by the broker in this case was $165.10, which means that the net cash flow was $972.90. Now, when you take that as a percentage of the investment amount, which is $1,450, this is a 67% return in cash flow over 187 days. And when you annualize that, this is a cash flow generation of over 130%. Now, why is this interesting? Because this is a penny stock, there's only so much that the penny stock will drop. And the amount that a penny stock, that a stock drops is actually a key determinant in the price of the call or the put contract and how fast you can recycle such a stock with the wheel strategy. So I hope that makes sense. If you've enjoyed this video, please, like we said, hit the subscribe button if you haven't done so already. Smash that notification icon. If you've got a comment or a question about what you've learned, please leave the comment or the question below and we will respond. And of course, please note that what you've watched and listened to here is not to be construed as financial advice. This is just sharing experiences based on what one sees on the stock market. And if you want to execute, it's always good to do your own research, find the right stocks that work for you, find the right strategy that works for you. If this strategy works for you, fantastic. If it doesn't, there's so many strategies for making money on the stock market. In our next episode, we will continue down the path of options contracts and we will explore additional ways that you can generate value for yourself using options. Thanks for watching and have a beautiful day. Cheers.